fundamentals are deteriorating. Demand destruction is real. China, some of the numbers that have been coming out of China are astoundingly weak. And of course, zero COVID is a reason for that. But I do believe China's been building inventories. And the reason it has been doing so is it's using the Russian war. It is buying oil from Russia at significant discounts. And we don't know how long this window will be open. The discounts reports are in the 30 to 40% range. So we would not be surprised to see inventories much higher almost everywhere in the world because of the war in Ukraine and the fears about not getting energy supplies, and China and India buying disproportionate amounts of oil from Russia. Russia doesn't have very many other places of size to sell that oil. Now, in terms of demand destruction, something interesting is happening here in the United States and probably elsewhere in the world. Many of you may have had this same experience. I was in California for the holidays, and I was taking Ubers. 3 Uber drivers were in Tesla cars, and I was asking them about Tesla. I found that curious. And they said, oh yeah, we're renting our cars from Hertz. Hertz is now not charging us as much to buy or to rent a Tesla. And of course, that's the preferred car. Later on, we learned from Hertz that Hertz is doing this because it has learned that maintenance costs for a Tesla, and I'm sure other electric vehicles, are 50 to 60% below maintenance costs for gas-powered vehicles. Now, the reason this is important is because of a metric we monitor called electric miles traveled. Now, Uber drivers are going to travel many more minutes of the day or hours of the day than we are in our personal cars, which we just park and leave as we go to work. So what this means is the number of electric vehicle miles traveled is starting to increase much more rapidly because of this Uber phenomenon, and sooner even than we might have expected. It is also very interesting to note that oil demand seems to have peaked in 2019. There has been a lot of demand destruction based on rising prices around the world. It'll be nip and tuck to see if we meet that 2019 number again. Now, if we're right, and I'll get into this in a moment, that number is going to drop precipitously because of autonomous electric cars. And so we believe that this notion of peak oil, which we used to, when we used that expression in the day, it was all around peak supply. We're running out of oil. Nowadays, the phrase considered more often, I would say, is peak demand. And we do believe that we're in the process of peaking out in terms of oil demand. At the same time, here in the US, we are moving toward record oil production. And once again, this year, we believe we could be the largest oil producer in the world. So again, supply versus demand makes a price. If you owned technology, consumer discretionary, or consumer services being FANG-like. Last year was horrendous. Anything in innovation was horrendous. How much actually happened on the innovation front last year? It was pretty astonishing, and the market just ignored it completely. Now, there are different reasons for these declines. For consumer services, of course, we have the Facebooks and the Netflix being disrupted. TikTok's a big disruptor. They're also now much more hostage to the cycle. Advertising is one of the first line items cut during a recession. And this is why we think we started in a recession early last year, because advertising fell off a cliff. And that is at least a coincident indicator, if not a leading indicator. So they're being disrupted. Now, in other innovation portfolios, true innovation portfolios, the new innovation, those stocks had a very bad year for a different reason. They're not being disrupted. In fact, they are more often than not the disruptors. They were penalized because they're investing aggressively now. And they are doing so because the opportunities associated with the 5 major innovation platforms around which we have centered our research, so robotics, energy storage, artificial intelligence, and blockchain technologies, they are ready for prime time. They are taking off, as I'm going to describe to you in a moment. But the winners are going to be those companies that are spending aggressively now, especially because with artificial intelligence, many winners are going to be in winner-take-most categories. So we want that. But when the market is focused on one quarter and wants its profits now and its dividends now, and the algorithms basically decide that anything without high profit margins or anything that disappoints on profit margins because of more investing, algorithms, they make none of these distinctions and they just pummel these sorts of stocks. Truth will win out. This reminds me very much of the late 90s for value investors. In the late 90s, value investors looked like they had 2 left feet, looked like they had gone dumb, stupid. And of course, that was the tech and telecom bubble that ended badly. And they were right, after all. Today, innovation investors look like they have 2 left feet, or that they've lost their brains. But we are more convinced than ever that these innovation platforms are evolving maybe faster than even we expected. And we believe staying away from innovation now is going to be as big a mistake as falling all over other investors to try and up technology weightings in the late 90s. So again, truth wins out.